So I ran into Michael Mesher months ago. There was a big article about his fund performance. It's got to be one of the top performers of the year. I've got to know Michael a little bit better. We have a podcast that's going to come out the next day or two of Michael about his fund. But what's interesting is that although he's had some really stellar performance, what's been amazing to me has been the consistency of the performance the last 16 months or so, where he's had 3 months over 30%. So that's always very interesting. I was thinking about David Einhorn, and his fund has finally gotten back into positive territory for the first time in 5 years. So, funds tend to go through dry spells. There's a lot of momentum investing when it comes to funds, but Mike's got a hot hand right now. So, Michael, if you can just introduce Gammon Capital, what you guys do, your outlook on the world. As I said, I was involved with like some of the guys from Protege Partners in the past who got heavily into AI-driven hedge fund investing. And so maybe you can talk about all the different angles that you're taking and go from there.
Yeah, great. Thanks, Marty. So as Marty was alluding to, we're a fund that has had a pretty good year. Right now, we're up about 650% on the year, gross. And I'm going to tell you how exactly we did that. But before that, I want to get into kind of a higher level version of what we do. We trade a lot of options, and we use AI and machine learning in the option space. We're able to extract a lot of edge. But more importantly, I want to start this conversation by talking about 2021 and the market and what's coming up. Because I've heard a lot of different narratives. The melt up is a very common one. I tend to agree with what Ed said earlier. I definitely think there's a lot of right tail risk just in terms of all of the easing that's been going on. And when I talk to other people about the left-hand tail risk of the market, which is typically the one that catches people off guard, is I notice that a lot of people are talking about coronavirus or the election, and those are real risks. But there's a massive risk at the beginning of 2021 that I haven't really heard anybody talking about, and I need to call everyone's attention to it before we get too far down the road on what we do. So I assume everybody's in front of a computer. If you guys go ahead and Google the CARES Act, this is the big stimulus package from last March. There's a couple passages that are buried in there that are really scary, and you need to be aware of them. So let's cut straight to it. If you're in the CARES Act and you go to section 4012, that's the part of the CARES Act that's going to talk about how the community banks have been relaxing their leverage ratios. If you go to section 4013, that's going to talk about how financial institutions are allowed to suspend GAAP, generally accepted accounting principles. Also in section 4013, there's an allowance that lets these institutions carry impaired debt as fully performing debt on their books for accounting purposes. Taking another step forward, section 4014, this allows financial institutions to throw out FASB accounting standards on how to calculate credit losses. This by itself is beyond scary. If you ever looked at a business and the business told you that we don't follow GAAP, we're throwing out FASB, we're lying about the quality of our credit portfolio, you would never invest in them. Yet everybody is looking at the US economy like it's the best game in town. And that's very scary. So the question becomes, when does the rubber hit the road? How long can this persist? And if you further read through the CARES Act, and you'll see this in the exact sections that I had laid out, December 31st of this year is the drop dead date. Without an additional stimulus package, which in the political climate is possible, but it's not a given, it's very conceivable that in 3 weeks, these risks are going to start to be recognized. And we think that creates a very large left-hand tail risk. Think of it as like an economic sword of Damocles over everybody's head that no one's recognizing. And it's that left-hand tail that really does a lot of damage to your portfolio. And it's incredibly important that you understand how to structure your portfolio so that you're able to take advantage of situations like that, or at least protect against them on the chance that this does get realized. So let's talk a little bit about portfolio structuring. I'm going to show a picture of my screen here and talk about payout profiles. Let's see. Okay. Hey, Marty, can you tell me if this is sharing? I can't see this on.
Yeah, it looks good.
Okay, great.
Yep.
So this is the payout profile that we construct for Gammon quite frequently. And the first thing that you'll notice is if you take a look at the orange line, that's the returns of the S&P. And if you take a look at the blue line, those are the returns typically of Gammon relative to the S&P. And the first thing that you're going to recognize is that this is a nonlinear return structure. And a lot of people are very curious, how do you do something like that? And for people that have traded volatility and options for their entire career, they're able to sit there and create very definitive payout structures. And the whole trick to this is basically making sure that you make money in as many possible market outcomes as is reasonable. And then obviously you have to have a trade-off where you lose some money. As people say, there's no such thing as a free lunch. So what you're taking a look at here on the screen is, if you take a look over at the right-hand side, whenever that blue line is below the orange line, that's where Gammon loses a little bit of extra money relative to the market. But if you take a look at the positive performance in the S&P, or once the S&P is down about 8% or more, you can see that there's a lot of long tail risk in Gammon. And this is where you start to put up incredibly exceptional returns. And this kind of leads me into 2020 and how we were doing in 2020. So when you think about portfolio structuring, there's a lot of different options out there that you can use to build your portfolio. On a product like the S&P by itself, you might have hundreds, if not thousands, of different options that you can use to express your thesis. So the question is, how do you go through and create the most efficient portfolios that give you the most convexity without having to pay the cost of carry that's typical for more basic strategies, such as buying a straddle or something like that? And that's where AI and machine learning really comes in helpful. Now, a quick primer on AI and machine learning. Whenever I talk to people on Wall Street, quite frequently, when they talk about AI and machine learning, they're talking about more classification problems. And these are problems such as, take a look at a picture of this car lot and tell me how many cars were there yesterday and how many were there today. And then I'm going to do the math in my models and I'm going to try and figure out if this rental car company is making money. Those are classification type problems. There's a whole nother sleeve of machine learning that's incredibly important, especially in the derivative space, and those are regression problems. And that's when you're able to sit there and do the hard math and statistics and the statistical analysis on how different mathematical positions perform in different environments. So basically, through AI and machine learning, we have the ability to identify what type of environment we're in. Are we in a high volatility environment, a low volatility environment? And we're able to construct these hyper efficient portfolios that are able to perform as the market rallies, but also as the market sells off very violently. Now, this structure is super important to us because one of the core tenets of our thesis at Gammon is that markets typically rally. Occasionally, there are transient drawdowns. And every now and again, usually without warning, there's a massive left-hand tail event, such as coronavirus. So if you're able to basically set up your portfolio so that you're making money in the situation where the market's rallying, you lose a little bit in the transient situations, and then you really hit the ball out of the park when the market gets killed, that gives you a lot of upside P&L while protecting your downside in a very significant way and without having to pay a lot for that. So this is the type of structure. This is what we did back in 2020. And as you might expect, coronavirus ended up working out exceptionally well for us as a long volatility fund. And we made money on the left-hand side of the tail, which is what you're seeing right there. And you can see that we have triple-digit returns in scenarios like that. But typically with long volatility funds, these funds lose money when the market rallies. And we made quite a bit of money as the market rallied, and people asked us how we did that. And that's a function of being long these tails on both sides of the distribution. So in this new world order where we have incredible stimulus that represents a significant right-hand tail, but we also have this very hidden risk in the CARES Act that no one's talking about and could be incredibly significant. That's left-hand tail risk that we're seeing. And then there's also the known potential black swans that everyone's aware of, whether it's coronavirus or anything like that. That also has the opportunity to potentially lead to a significant left-hand tail event, but it's not entirely a given. So what's really the most important thing is just structuring. And that's what we spend the majority of our time doing. That's what we excel in. And that's how we plan on providing edge both in the past, but also going forward. And it also gives us the flexibility to perform in different markets. I want to keep this kind of simple and short because I know we're running a little bit behind on time. So if there's any questions or anything like that, I'm more than happy to take questions.
Mike, just keep on going, Michael.
Okay. So in addition to the quant side of our program, which is really what you're looking at here, I was also the head of special situations volatility trading at Lehman and Barclays. So while the quant approach is really the bedrock of our program and what you're seeing in terms of structuring, we also have the occasional opportunity to venture into a special situations type opportunity. And something like that might be, for example, this CARES Act. We are carrying more left-hand tail risk than we typically would because of this special situation. Other special situations that can happen that are usually fairly lucrative is any sort of spinoffs, split-offs, any sort of reorganizations. Those things are usually well documented and covered by the market. But by the time you start extending yourself out into the option space, they're not as well covered. And options, at least if you're long options like we are, they give you significant upside leverage. So we're able to take advantage of special situations as well to come up with certain asymmetric risk reward profiles where our risk is very contained on the downside, but we have significant upside. And that's really one of the most important things about trading volatility. A couple of years ago, I gave a speech, and it was about how to identify the volatility managers out there, basically red flags that you'll see on a lot of the volatility managers out there. Because at least in my experience, having talked to a lot of people in the industry, typically when people have encountered volatility portfolio managers, it's usually someone who hasn't been in the space very long, maybe a couple of years. And their first trade is to just go out and sell options. And they chalk this up to selling insurance. But the problem with that is eventually coronavirus comes or the stimulus expires and everybody gets subject to this black swan. And that's the end of that trade. So you'll have these managers who put up very consistent returns over time, but then they just blow up entirely in a matter of days, if not shorter. You have to contrast that with being able to buy volatility and being able to run a long volatility portfolio. And this is really where you need to have spent a lot of time. I've got 20 years in this business so far. But the type of structures that you're able to create, especially when you start to use machine learning and AI, those are the tools that you need to be able to build long volatility portfolios that are able to perform on both bullish and bearish scenarios. So if there's one thing I'm going to harp on over and over and over again, it's not that we're coming in here and we're saying that we understand the market better than everybody else. That's a very common edge that people like to use. We don't sit here and typically opine on the markets. What we do is we recognize distributions and we try to fashion our payout profiles accordingly, because as the volatility markets move, there's different opportunities to take advantage of the different payout structures. And as you start to engage with more sophisticated volatility managers, whether it be with Gammon or somebody else, you'll start to learn that the better the manager, the more efficient they can structure these portfolios. So basically, the more ways they have of making money in multiple different markets, while only taking a smaller downside on what we would consider lower probability events.
So Michael, I do have a question here, which is my own personal question. So I'm a chess player and I'm not really very good at it. But one of the consequences of AI in chess has been that there's been an explosion of grandmasters in chess. Mm-hmm. And so what's happened is that things like Deep Blue and actually just your cell phone chess game makes you better and think about different situations better. So when you use AI in your trading situations, do you feel like you're getting a more rounded, better perspective about all the different ways that your trade can go, and so you're far more comprehensive than you've been in the past? Maybe you can discuss that a little bit.
Yeah, without question. That's one of the great things about the AI and machine learning, and it's taken us multiple years to build this infrastructure. This is not the type of thing that you can just go knock out in a weekend. And over the course of years, it's basically been like laying the foundation of a building. And now that that foundation is there, we've started to scale. And by scale, I mean we're able to go out and we're able to analyze many, many names. And as we analyze all these names, we're able to take our computer IP and we can go out and we can analyze tens, if not hundreds of thousands of opportunities that are available to trade at that given moment. And then we can take a look at the context we're in. And when I say context, I mean the market environment. Because certain trades perform well in high volatility markets and other trades perform better in low volatility markets. So the question becomes, where can I get the most convexity? Where can I get the most whip? Basically, where can I get the most rich asymmetric risk reward? So we'll take a look at that. We'll also call out a couple other investing objectives that we have, whether it's risk adjusted returns or win rates. And we'll analyze all of those variables in the context of the market. And using the AI and the machine learning, gives us that ability to go out and analyze 100,000 different opportunities in 1 second. And historically speaking, before AI, before the machines got incredibly powerful, before the cloud, this was never possible. I mean, I used to be at Lehman and Barclays. This is probably 5-10 years ago at this point. And there was never, ever, ever any IP that could even begin to make those kind of analytics. I've also talked to a number of volatility hedge funds out there, just in passing, and I don't see a lot of people putting that quant work to work in the volatility space. And I think that's just a function of the amount of data that you have to sift through, the steps that you have to go through for data integrity to make sure that you are, there's the garbage in, garbage out problem, and you have to make sure that you've dealt with that. Otherwise, everything is a waste of time. So it's really been quite an investment in the time and the infrastructure to be able to set up the machine learning such that we're able to go out and analyze all of those different opportunities and then use those opportunities in tandem to create these hyper efficient portfolios that are able to perform in all types of different markets.
Keep on going.
Okay. And outside of that, just in terms of building up the firm, we were originally running this as a managed account. About 2 years ago, we had somebody approach us who had read about our IP, and he asked us to run some of his money in his proprietary strategies. And we've done that for 2 years now. The annualized net returns, last I checked, was about 120% a year net. And now we've had additional people who wanted to come into us to put money with us. So we recently opened up a commingled vehicle to be able to cater to them as well. Same strategy, we just moved the positions over from the managed account into a commingled structure, so we're able to add additional funds. Currently, we're about 20, 25 million. But the great thing about options and a lot of the options that we're trafficking in is these are some of the most liquid options on the planet. So we have the ability to do everything that we're doing, but we can also do it at 10 times the size. And there's no change in our liquidity profile. So there's no additional costs, there's no frictional costs that are incremental on top of what we're already doing. So the great thing is we're able to scale this out. And since we've recently been able to bring our IP to a place where that's able to scale as well, we're able to scale the IP much quicker than we're able to scale the assets. So we're currently in a situation where we continue to have significant edge, but we're also out there and we're starting to get the word out a little bit on what we're doing, because historically we've always flown under the radar. Any questions or anything else I can do there?
Actually, if you read the chat, there's a couple of questions asking you about opportunities outside the U.S. and whether the rest of the investable universe conforms to this technology and viewpoint that you have.
Okay, so I'm just looking at the questions right here. So in terms of other markets, we've been focusing mostly on the US. We do have exposure in some of the foreign markets. One of the things that's really important to us is that we diversify across many different variables. So we'll diversify geographically, but we can also diversify our convexity profiles by trading different options of different durations. So we also diversify across time, we diversify across assets, we diversify across directional risk and volatility risk. Historically speaking, people who trade volatility will take each of these individual risks and they'll try to zero out each of those risks. But when everybody does that the exact same way and there's no innovation happening and everyone's hedging exactly the same way, a lot of the edge goes away. But once you have access to powerful AI, you're also able to understand how each of those variables can be hedged against each other. And that creates a significantly more efficient portfolio structure than what typical options traders would use. So when you ask about different countries, we do operate in different countries. These are also the types of strategies that we could roll out to any markets, although we mostly focus on the US, with our exposure outside of the US being more in terms of ETFs and other exchange traded products.
And can you talk about your fund capacity and this strategy, and then you talked about some other things that are available in 2021 and that capacity?
Sure. So in terms of strategy capacity, like I was saying, we could be 10 times as big as we are right now, and we wouldn't move the market at all. Whether we're trading S&P options or VIX options, 95% of the trades that we're making in our fund are related to exchange traded funds or other exchange traded products. So the liquidity profile is great. So we're able to scale up very quickly and efficiently from that perspective. In terms of going forward, 2021, I obviously talked a little bit about what's happening and this giant, giant left-hand tail risk that nobody is paying attention to. I think because of that, we are carrying a little bit more left-hand tail risk than we typically would. I mean, needless to say, you can tell from 2020 that we perpetually carry a lot of this long left-hand tail risk. But in the environment that we're getting into right now, it's super exciting because as the markets rallied over the course of the past 5 or 6 weeks, implied volatilities, basically people's expectation of what volatility will be in the future, has come down significantly. And when people's expectations of future volatility come down, that makes options as an asset class significantly less expensive than they otherwise would be. This is super important because as those options become cheaper and cheaper and cheaper, the convexity that you can get goes up and up and up. So when I talk about convexity, I'm talking about that asymmetric risk reward where you risk 1 to win 5. But as the market gets into a more low volatility environment, your risk reward might turn into something like risking 1 to win 10 or risking 1 to win 15. So that's very exciting for 2021.
So Michael, we had Ed Yardeni on earlier today, and he was talking about, how we've gone into this kind of like la land of modern monetary theory. And, my concern obviously is moral hazard because government's picking winners, right, by extending lines of credit. I mean, so forget about value investing. This is kind of it destroys whatever's next after value investing, right? So do any opportunities come forward as a result of MMT or your thoughts?
So in terms of the opportunity set going forward, when we think about macro policy and what's going on in the world, that's another situation where we don't necessarily opine on direction. I mean, I can sit here and I can repeat the thesis of money printing like everybody else, and I believe it. It makes sense to me. And the way we would think about that is not so much going out and pounding our fist that it's a bull market, just default to your equity long short strategy and get long beta. That doesn't really make sense because you're not carrying that risk that you need. You're not carrying that left-hand tail risk. And everybody's aware of this. As the crowd starts to move one way and everybody starts to have the same mentality, which is economy's fine, nothing, no problems, nothing to look at here, biggest supply and demand shock in the history of the planet, but everything's fine. We're able to take a look at that and say, okay, that creates more tails in the distribution, whether it's the right-hand tail of money printing or the left-hand tail of the entire crowd having the same mentality and then realizing that's not the case and the emperor doesn't have the clothes that you thought. And then they all move to the other side very, very rapidly. It's those shifts in mentality that move volatility up and down. And whenever that volatility starts to move up and down, those are exceptional situations for us where we can make a lot of money very, very quickly.
Well, fantastic, Michael. That's really great. And, I appreciate your giving us insight into what your strategy is. Any closing comments or?
If there's any other questions, I'm happy to take a look at that. In terms of the strategy and the AI and the machine learning, I'm happy to do deeper dives offline. I try to not get too technical in some of these speeches. Sometimes I can nerd out a little bit because I spend a lot of time doing this and I really enjoy it. But any other questions or if people want to explore any of these theses or how to protect against that, that's all things that we're able to help with offline. Be happy to.
Fantastic, right? And again, Michael, you ran trading at a very large firm, and I think a lot of times innovation comes from the smaller firms. So it's innovating a lot.
Yeah, just to mention on that real quick, quite a while ago, I was running special situations volatility trading for Lehman, and that became Barclays. And that was one of the things I noticed, and that was one of the things that really drove me to want to start my own firm, is when you're sitting in the bank and you're looking around, everybody's sitting in a great seat. And a lot of people are very happy with what they're doing. And it's just kind of come in, wash, rinse, repeat. It's the same thing over and over and over again.